2016 has been a pivotal year which saw market resilience to some shocking results, including Brexit and Trump's election victory. And there'll be more stock market resilience needed when Europe's key elections take place in 2017. Richard Hunter of Wilson King Investment Management joins me now to explain the main challenges to the global bourses and how we can attack them, I suppose. I mentioned a few of them there. Obviously, Brexit, Trump, we had the Italian referendum. There's not been a dull moment, has there? No,
and that's, as you say, likely to continue. There's a number of elections coming up next year, including in the likes of Germany and France. That'll be interesting to see whether the waves of populism, which have already washed up on the UK and US shores, transfers over to mainland Europe. But in particular, I think one of the things that we are likely to see next year is, up until now, it's all been about estimates. In other words, if you think about the Trump election, obviously he doesn't get inaugurated until January. In terms of Brexit, we don't trigger Article 50 until March. So up until now, the market positively has been anticipating what's likely to happen as a result of both of those things. Next year, we'll start to get a much better idea and some real meat on the bones, because particularly in the US, there's a lot of guesswork going on at the moment about what Trump will actually do to further inject life into their economy.
And also wishful thinking, because actually it's all positive in terms of what they're expecting, isn't it? And all of this cash to be repatriated back to the US, and some of the markets, as we know, the financials, infrastructure, pharmaceuticals, they're all reeling off of his victory. Do you think that that will come to fruition?
Well, that's the thing, isn't it? We've got the Dow Jones nudging 20,000 at the moment. We've got the other indexes in the States which have been close to or near record highs for parts of the year. So there's a lot of scope for disappointment there. And I think the other thing the market needs to bear in mind, of course, is that even if he goes ahead with the tax cuts and or the infrastructure spending, it could well be late 2017, even 2018, before that really starts to take hold. So on that basis, what we do need to see is companies continuing to keep their side of the bargain and keep those earnings up. We had a very strong third quarter reporting season. That clearly needs to carry on into next year as well.
You mentioned as well in some of your analysis in what all of this can do to the earnings. Actually, euphoria.
Yes, that's right. The other issue we've got, of course, is this, depending on what sort of tax holiday he introduces in the States, you could see a repatriation of a lot of the funds that are currently held over the sea back to the US. Now, if history is anything to go by, we're talking hundreds of billions of dollars here. A lot of that money could go into share buybacks, which by definition would improve company earnings. So that's the sort of boost that we're going to need next year to maintain valuations, which in the States at the moment aren't looking expensive, but they're beginning to look a little bit rich.
Okay, let's move on from the US and talk about Britain then, because obviously we had Brexit. In terms of next year, you mentioned Article 50. Of course, that's going to take place March, we think. What's going to happen, because we've got inflation, huge risk, these import prices, they are going to excel. What are you expecting in terms of Britain? Can we gauge this storm?
This is an interesting comparison, because, of course, on the face of it, there's no sign of an interest rate rise on this side of the pond anytime soon. Having said that, we've obviously seen the weakness of sterling, and also whatever happens with the oil price, we could find ourselves importing some inflation. So that's sort of starting to emerge onto the horizon. Quite apart from the fact, of course, in the background, at some point, QE has got to be unwound, and that's going to be a big task on its own as well. The argument goes, of course, is that inflation is probably a little bit easier to deal with than deflation, because if inflation is starting to get out of hand or in any way rampant, then obviously the Bank of England has within its power that northerly path on interest rates.
And actually inflation is what a lot of the world want right now anyway. In terms of international pressures then, let's talk about China. You mentioned India as well. What big factors are we looking at in 2017 in terms of international global bourses?
Well, particularly for the FTSE 100, for example, it's made up, there's a big stock of miners in there, and obviously commodity prices have been one of the reasons that the FTSE's done fairly well this year, and indeed European bourses in general. The slight concern is we've seen a sort of re-emergence of that Chinese demand this year. Now, the big question mark, which we won't know until next year, is whether that demand is going to continue, or whether China are doing what they've done in the past, which is stockpiling in 2016, in which case demand could fall off a little in 2017. That being said, of course, India, you're absolutely right, another massive economy, massive country, and also going through a fairly fundamental change.
Where else do you think next year, in terms of the global economy, could upset matters?
Well, we've got the Italian banking situation, of course, which needs to be dealt with and hopefully contained. Banks in general do remain under the cosh with historically low interest rates, let alone the straitjacket that regulation is increasingly putting on them. That's one of the reasons the financials have had a pretty good run of late, the stronger banks anyway, on the basis of potentially lighter touch regulation in the States. But financials will always be pretty much at the centre of this, and obviously, if there's a bit of inflation which leads to slightly higher interest rates, that should be good for the banks, but they do remain an area of potential danger.
And Richard, just to conclude, in terms of historical highs and all these numbers that we're looking at right here, where's the correlation between the real economies and the stock markets? Because if you look at the US, even if you look at Britain, they look entirely separate sometimes.
Yes, they are. The market, of course, is a discounting mechanism. In other words, it's probably at any given time 12 to 18 months in advance. It's trying to anticipate where we will be, which of course is a particularly difficult thing to do. It's why we philosophise about whether it's an art or a science, of course. The fact of the matter is that the market is much further out, and obviously we therefore have to react to news on a daily basis. But yeah, I mean, even in terms of the FTSE, the 7,000 figure per se, it is fairly meaningless, in as much as when we last hit it at the turn of the century, if you compare the constituents then and now, they're two completely different indexes. So it's a bit of an apples and pears comparison, just looking at that 7,000 figure in isolation.
Okay. Richard Hunter, we'll leave it there. Thank you very much indeed. We're all set now for 2017. That's Head of Research at Wilson King Investment Management there, talking to us about the global bourses in 2017.